Hey trader, Stacey Burke from Stacey Burke Trading. Today we're going to be talking about peak formations and how they can help you identify your session bias and your levels for buying and selling. And just to review, we'll run over last day, a lot of questions again. I'm going to go over the timings. So again, Asia 8 to 11 p.m., Europe, London 2 to 5 a.m., New York 8 to 11 a.m., New York time. Instruments, it can be traded on anything, but today we're going to specifically talk about the major pairs as well as commodities and indexes. We're talking about the high of day and low of day. Important to really understand the peak formations and the timings. If you're trading outside of the timing windows, you want to make sure that you're trading in the direction of that underlying bias if it has movement moving in one direction, so that you're not counter trending and looking for a high or a low in the middle of an existing move that could continue to grind its way until the next window or just trap volume. Three things that markets do: trend trades, reversal trades, and trading ranges. Now again, this is your choice. I use the 15-minute charts to identify my levels. It doesn't really matter because the timing window is set, and I don't look at the levels until that time expires into the next window. So I don't have a high and a low until that timing window is complete, which means that my 3-hour window for trading is there. But if I come to the Europe window and the high, and I'm looking to short the high, 2 hours before Europe starts, well, then I know that the high may not be in place yet. It may be in place, but they may go right back to the high when Europe opens. So if I'm not in that window for the initial move, I wait until the next session starts. And hopefully this will bring some clarity and understanding to that. Triple tops, double tops, triple bottoms, double bottoms, 3 push patterns, head and shoulders, A tops, V bottoms. These are all the types of patterns that will occur on all time frames, but specifically when we get to the extremes, the 1 minute help you get a best price fill. You don't have to. You can trade on the 5 minute, the 15 minute. Often it may not be too much of a difference, but again, it's your preference. Risk management, again, if I'm shorting up near the high, my stop's going to be at the high, and usually typically a maximum of 15 pips. So on gold, oil, NASDAQ, 20, 25 max. If it goes past that, I'm wrong. So usually if these trades are starting to move, it's a 20 pip stop for me, because once they go, they should not come back. If it breaks a swing high or swing low level, I move it to break even. Profit targets will often be the opposite extreme. Now that depends on the day, the template, the session, etc. So we can see measured moves, we can see 50 pip high-low ranges, we can see 100 and 300 pip high-low ranges. Often you're not going to see the same on major currency pairs, but as we saw this morning, we can get 100 pip moves, no problem, when these are set up properly. And we've talked about the 3-day setup. Today, peak formations and 3 levels of rise or fall are our main focus. Just to reemphasize, I do not trade the news releases themselves. I will trade before the news and be out on major news, and I will trade after major news with my underlying thesis and bias in place. If I'm already in an existing move and I see the news as a potential catalyst, I'll remove a portion of a trade and let a trailer perhaps capitulate and exhaust that move. That's personal choice again. It depends on the setup and how far advanced that existing trade may already be in play. So most of the trades are done and dusted pretty fast, usually within an hour. Occasionally there may be a trailer that runs. If it's for Friday night, for example, NASDAQ, it could be a continuing move into the end of the session. Oil, same thing. Again, that's a choice of the trader. Most of the trades will be over in 1 hour. Imperative to have the concepts to identify your bias, but also to not just be looking to try and catch a move, but to know the setups that you're looking for and then build your best trade setups. Filter out the garbage stuff so that you're not guessing and just trying to, randomly catch pips. Focus on setups that are going to give you asymmetrical risk reward at specific times with specific criteria, and understand the mechanisms of those trades and then execute them. And when they show up, which they do repeatedly, if you're following multiple instruments, you'll know what to look for and how to identify the best candidates for trading. So peak formations help you identify the session bias, and today, hopefully this will clarify some things in terms of understanding three levels of rise, 3 levels of fall, help you identify the most relevant peak formations, especially heading into a new week or in the middle of a 3-day cycle. This is what will form the extremes, and then the market will often trade back into the extremes or away from those extremes in the upper third or lower third, trapping volume. Now, sometimes the boxes may be 3 levels of 25. Other times it may be 50. And in some cases, NASDAQ oil, it can be 300 pips. So 100, 100, and 100, which we see quite a bit on those pairs. But you do not want to counter trend those markets if they're in the middle of a move. And if you're not in that existing trade, you want to come back later in a session, or if it's in that session trade, wait for that current session to counter trend that move before you re-enter the trend. So often you'll see a stop hunt. People will counter trend the move on the stop hunting and catch a 25 or 50 pip trade, and then the trend resumes for a 100 pip move. So we'll look at some examples of that. We're going to look at the previous days, high of day and low of day, and the relevance that they play. So first thing I do, new week, new day, is where are we at in the cycle? Are we at day 1, day 2, day 3? Now, I've talked about this in several videos. We'll review that one more time. But whenever volume gets trapped at the low or high of a week, that's when I start my count. That's day 1. Now, there's been some confusion about Monday, Tuesday, Wednesday. Monday is the day 1 of the weekly cycle, but I could be in day 2 of a 3-day cycle in terms of the trading move, and we'll go over that as well. So it's important to know, have I broken any weekly high or low levels? Now, psychologically, I explained this to somebody this morning. When high and lows of days are broken and weeks are broken, you trigger other time frame traders into the market. When you are at an extreme, you have people now entering into the market on multiple reasons and time frames. But remember that the object of the game is to be buying low and selling high. So whenever you breach a high of the day or a low of the day, you may be looking at a level of selling or buying. So you want to be able to identify the most relevant peak formations. Now we'll go over that and define what they are. That's what forms the extreme, and then you can identify your 3 levels of rise or fall. And then from that information, you'll be able to determine if it's a 75 pip range, a 150 pip range, a 300 pip range, or just a 25 pip high-low, which means that volume could already be at level 3 or level 1, and they're trapping volume. Maybe even over Monday, Tuesday on some of the Euro, for example, could be a Monday, Tuesday 25 pip box. Wednesday's an explosive 50 to 75 pip move, and that can come back to what's on the news calendar. That can come back to the overall pattern of the weekly templates building into that. So when a new day starts, yesterday's high and low are possible levels of support or resistance. Now, if they're inside of weekly levels and we've come off of a day 1 low of the week or high of the week, that high or low of the day may be a continuation area, which means that the peak formations that are already in place, we will be inside of. And hopefully that will be clear. We'll go over that. 25 to 50 pips above or below those areas are potential strike zones if they are reversal or continuation points. So, for example, we could be at a high of a day from yesterday and the market may fall 50 pips without taking out yesterday's high because it's coming back inside to put a low of the day in place. Now, I talked about focusing specifically on session times. Traders will sit at the screen for 3 hours waiting for them to put the low in when all they need to do is come back later. If they miss the low of the day, what does that tell you in the next session? It tells you that they're already going long back to the high of the day. So you're looking for longs in the new session. Long trades inside of the low of the day. Don't counter-trend the peak formation. Critical to understand. Now, when we look at the charts, this will make more sense. You can therefore then measure the highs and lows with your levels, 3 levels, 75, 150, 300, to identify your strike zone price levels, 50s, 75s, double zeros, 25. If the low of a range is at 60, for example, then 75 may be our strike zone. If they are going to do a stop hunt, then somewhere between 50 and 25 may be our strike zone. So the timing is critical, and understanding whether or not they have already locked in the high or the low before the session begins is imperative to understand, because that revisit to the extreme can be the stop hunt. That's what will trap traders in the wrong direction, and that's what forms the new peak formation into that new session. So if the high or low have already been locked in, your bias helps you identify the trade for the next session. We can look at any instrument. We'll randomly scroll through. We're looking at the New Zealand dollar. So today is Monday, and we'll just bring our weekly separator up again. So today is Monday, differentiated by our pink line. So I said the first thing I want to do is identify a peak formation. So on Wednesday, we had a peak formation high, and we had volume that broke through Wednesday's high and reversed. So again, traders have gone long on the news. The news went down, hit stops, broke through the high of the day, and then reversed. First red day. The next day, we come into the market. We'll blow this up. I don't have any number levels on here because I just want you to purely focus and understand the level of measuring peak formations. Our peak formation is up, which means until we see an opposite peak formation, we will trade in line with the down move. The down move then, if we're going to short this market, we want to see a market go 3 levels of rise or fall for us to go short. So we need to see the market move up in 3 pushes, 50, 25, 50, or 75 pips for the short trade. Now the market falls and puts a low in place. The low is at 62.72. If it'll make it easier, we'll put our 12 candle window on here for people to see the numbers. 72. That's 75. 3 levels of rise from 75 of 25 pip boxes would be 50. 63.50. But the market moves up in 1 push, 2 pushes, and 3 pushes, and only stays inside of a 25 pip box. That's my short trade, in line with the peak formation. Now, if I measure 3 levels of drop from the peak formation, we've already broken 75 pips. What that tells me then is that now we are going for another 3 levels of drop, which would be 75 more, or 150 from the peak formation. Our short trade drops 25, 25, but it doesn't quite get down to the 3rd level. It pulls back with a 1, 2, 3 into the Europe-London window. Traders short it, doesn't go any lower, pulls back, goes a second time, doesn't quite get there, pulls back in the gap a 3rd time, and almost gets to the 3rd level, but we are already on level 3. Where can this trade fail? It can fail in level 3 or have two-sided trading. The market proceeds to work lower, works a little lower and pulls back, and then continues the move down for 3 levels of drop from the peak formation. So, from our original peak formation high, we have now dropped 150 pips. 2 levels of 75. So, if that's my level, and we come into Friday's session, they break that level right at the beginning of the day, and the market proceeds to auction up into the beginning of the session. Now, if I take the low of this candle, 62.05, 62.05, and I calculate 3 levels of rise, that should take me up to 62.75, 62.80. But the market again goes up and puts a high in place, pushes a second time, and then 1 push, 2 pushes, 3 pushes into the open of the Europe session for a short trade, which breaks structure. They pull back in 3 pushes, 1 push, 2 push, 3 push into the high, and we have a new peak formation high. The market auctions down 25. A second push doesn't quite go down, and then the third push at the beginning of the U.S. session, which is in the middle of the box, low-hanging fruit, to the low of the day of London, giving us an engulfment candle on the first level after 3 levels of drop for a long trade back up through the high of the session and towards the high of the day. So 3 levels of drop, consolidation, hit the previous day's low, market forms a new peak formation long inside, and then puts in a peak formation low for the reversal back up. Now this morning, we have our previous day's high. The market goes up and puts a high of the day in place first. Hopefully this is making sense. We have our high of the day. That's 1 push. Now come back and put our line at the low of the day and calculate the distance. The low of this candle is 62.60. 50 pips from 62.60, which is 25 to 50 pips from this distance, is 63.10. 62.60 and 50 pips is 63.10. The market has gone up to 62.89, 62.92, and a third push in the Asian session to 62.91. But that's only 32 pips, Stacey. Okay, so now we've only gone 25 pips above the low of the day at the previous day's high with 3 pushes, a low of the day in place, a higher low, which forms our rectangle and our triple top on a 15-minute chart at the high of the day, on our third level of rise, 25, 25, and not quite 25 with 3 pushes at the beginning of the new day, at the beginning of the week. I'll just bring this weekly separator back up. For a 50 pip reversal trade back to the longs on Friday night's U.S. session. Now again, this is a 15-minute chart. What I'm emphasizing to you is that everything is measured and calculated by distance. 3 levels of rise. If the market doesn't go 3 levels of rise, and we're in a 25 pip box, the pattern will already be inside. The next session will give you the trade. You may not get your big trade because you're in a day now that's flipping the book at the low of the week. Reversal, 3 levels of rise, 1 push, 2 push, 3 pushes, without taking out the previous day's high for a 50 pip reversal trade straight back down. 3 levels of rise, we're on the third level for the reversal trade back down. Somebody pointed out a very great trade this morning on the pound yen. So again, identifying my peak formations, we'll just put the weekly separator back up here. If you can grasp this concept, you will be able to have a bias, a very measured, accurate bias each session heading in. And again, understanding that not to focus on one pair, but to look for the best setups, whatever pair gives you. There's an example, New Zealand dollar, that, that's a great trade on the New Zealand dollar. So if we identify our peak formations, peak formation low on Thursday. Now, my last peak formation high on Thursday was down low. My larger one was towards the latter part of the day on Thursday, but as the day auctioned lower, we had lower peak formation highs. We had a peak formation low put in place, and afterwards we had a peak formation high put in place. And that last peak formation high plays a similar role as the low and the high of the day. They traded then in 3 pushes, 1 push, 2 pushes, 3 pushes into the peak formation low. That's called counter-trending the peak formation low. That's a squeeze trapping shorts at the low of the week and the low of the day. When they come through here now, the market is in a long reversal state. They take out the lower highs. And let's measure the distance now from this, not only this peak formation low of the day, 55.59, 155.59 to 157.93. That's approximately 250 pips. That's 3 levels of 100, and in the third level it's failed at the 50 level. So again, an example of 100, 100, and into the third 100 level, it exhausting itself. And again, that high of that candle is at 93, which tells me on the last level of that 100 pip box, between 75 and double zeros, it reversed. 1 push, 2 push, 3 pushes. There's our peak formation high in the Asian session. 3 levels of rise in Asia. Traders are inside here during London looking for the trade. The low of the day is down here. That's the last peak formation low during the day. Now, do you see what they've done? They've put a high in, and then they've worked into the low in a long existing market, into the U.S. New York Open with a W pin hammer reversal. Now, we'll put our numbers on here. The same process applies on every single instrument. So, again, just re-emphasizing that everything can be measured and calculated, and then if you respect the timing windows, you can identify the levels. They've already locked in the low of the day. I want to get filled down at double zeros. If I can't get filled at 0, I want to get filled below 25. What that means is that if they don't give me an opportunity to get filled at 0 because of the speed or velocity or the nature of the price action, I want to get filled below 25. And again, I'm on a smaller time frame. So this is where I get my levels. I'm on level 1 of a new 100 pip box in a market that is now long. My first target is back to the high of the day. It's Friday. We've already locked in the low of the week. I want to get filled down below 25. I want to get filled at 0. Perhaps I might have. So the market has come up 3 levels from Thursday. 100, 100, and 100. We've gone up 3 levels this morning. 25, 25, 25 plus. We've gone into the peak formations from last Thursday. On our 1-minute chart, we have an engulfment at the last level of rise. They've broken down, pulled back above 75 with an engulfment for a short trade all the way back down. We've now broke through the low of the day on the 3rd level. They've put a low in place and pushed back up 1 push, 2 push. I would like to see another 3rd push back up at the London Open. If this continues to go lower, we could see a move up in the U.S. and a continuation down. But at this stage, we are still in an existing short trade down. Do not counter trend the peak formation. We're on the 3rd level. We've had a peak formation high. We've peak formation low on Thursday. If you can understand these peak formations and then measure the levels of rise and fall based on your timing window, you'll be able to have a thesis for each session and an expectation of what's reasonable in that session for either a 25 pip, a 50 pip, or a larger move. It might be 25 in London, 25, 50, 50 down, 25 up, whatever that is, or an existing trend trade back through the high of the day from the low of the day. If you can't get filled right at the numbers, then you know the levels you want to get filled at or better than for the move back through the high of the day. So you can understand why you can use smaller time frames when you already understand the levels that you want to get filled at and the underlying bias that you have for a best trade setup. So again, not trying to guess a direction and catch a move, identifying a best trade setup. This is a best trade setup to me. 3 levels of rise on the third level, an engulfment pin hammer through stops for the reversal trade back in the other direction, catching higher level longs or lower level shorts down low. So people ask what trap volume is. This is all trapped. Once they engulf this, it only takes one candle to trap all these longs. The second candle gets everybody. That means they're trapped. The chances of them coming back up above this level, you'll notice where the closing price of all the bull candles are at. Everybody's underwater if they haven't taken profit, gone to break even, been stopped out. So when you identify the levels, it's not about watching the candle action for hours to see if they put a higher low in place. You should be able to come at a session window and see what's happened already. 3 levels of rise or fall. Put in a high or a low, and then wait for stops to get hit. Know what your levels are, where your target is. If you want to leave a trailer in a trend trade, so for example, we could get a stop hunt back up. It could be a U.S. session sell for a move back down to the low of the week. It could be a buy low setup for a reversal to the high of the session, whatever that is. You can make a determination as to whether or not you want to be fully out, leave a trailer in, where that trailer may take profits. So again, if they go 75 pips and it's a trend trade and they're going to go 150, well, that trailer may be taken out on the third level of rise of 50 pip boxes. Just lastly, real quickly, the process applies to any instrument. So this morning, short trade on oil, okay, low of the week, peak formation, day 1, day 2, day 3 reversal last Wednesday. They come out of the low of the week. They triggered the previous day's low first. I won't go into detail, but this is this little peak formation inside that forms the W. It's 75 pips from high to low, 3 levels of drop right into the initial stop hunt. The reversal comes out of there. They put a higher lows in. These higher lows form peak formation reversals. Peak formations, which are the same as low of the day, high of the days. Don't counter trend the peak formation. So we have a high of the day that's a peak formation. They auction down. They continue the move down in line with the peak formation high of the day, which is exactly the same setup they did this morning right here. This market proceeds to fall. So I take the high of this candle. That's the high of the day. 106.23. That's 106.25. So if I drop that just guessing 300 pips, that takes me to 103.25. 103.25 is 3 levels of 100, which on oil, actually I'll move that. On oil can be expected, no problem at all. 25. There's 300 pips, just guesstimating. And what do we see right at the beginning of the Europe-London window? A pin hammer, a middle structure, a pullback, and an engulfment. So, as I have said before, with oil, I would look for the majority of the larger moves in the New York session. I'm not saying that I traded this. What I'm suggesting to you is to understand the measurements and calculations, and then if I come into New York, my bias is that if the low of the day is locked in and we've had 3 levels of drop, and they're working back into the low of the day at the beginning of the U.S. window, my bias is to be looking for a long trade at the levels down in this area for a long trade back to the high of the day. We're on day 2 after the low of the week. Day 1, day 2. They auctioned down 300 pips into a peak formation low after day one. On our 15-minute chart, we can see that our levels are down. Now, so again, some people's levels may be different on their charts depending on their broker. We've gone down to 75, locked in double zeros. They've then risen 3 levels of 50 and put a peak formation in the London session. So 150 pips up, I can expect probably a minimum of 75 down. 3 levels of drop, right? 1, 2, 3 levels of drop and the reversal into the U.S. session. This is the same as the pump and dump, except it's called the dump and pump. So we have our underlying thesis of looking for a long trade. It doesn't mean I have to buy in the first hour. Okay? What it means is that when 9:30 New York opens, though, if I already feel that London's locked in the low of the day, they've come down and locked in the low of the session, breakout pullback, 1 push, 2 push, 3 pushes, 9:30, not quite at 9:30, but we're into the second hour now. There's a vertical move through the high of the day. So it doesn't matter where you get in if you understand that you're going in one direction. They come down and lock in the low of the day. How long did that take? 2 15-minute candles, 30 minutes. They proceed to auction up in 3 levels of rise. There's our first hour, putting in our high and our low of the session inside of the high of the day. They've gone down first without taking out the high of London. They've broken structure. They auction back down to double zeros and 3 pushes, breakout pullback, second hour opens for a vertical move. So again, time compression, measuring the levels of rise and fall. You could have got in down here. You could have got in more, added, whatever you want. Take this off, get back in, but our underlying thesis is that the low of the day is locked in inside of the peak formation, and we're going back to the high of the day on day 2 in our weekly template. So hopefully you got value from today's video, traders. Form your thesis. Don't get stuck on just focusing on one instrument. Look for the best setups. 3 levels of rise or fall. A peak formation can give you the majority of information you need, whether or not the high or the low of the day is locked in, or from a previous day. You may be trading back up into a peak formation on level 3 for a sell, or down to level 1 for a buy. Keep it simple. Master your craft. Start the week off strong. And may the markets go with you.